Hey, Leonardo. So it's good to meet you. And why don't we just get the interview started? Can you just first walk me through kind of your experiences and tell me about yourself?
Yeah, sure. And first off, thank you for having me, Ben. It's a pleasure. A little bit about my background. I was born and raised in São Paulo, Brazil. I moved to the U.S. when I was 17 years old on a academic and athletic scholarship. I studied mechanical engineering and was also the swim team captain. My first meaningful hands-on exposure to finance basically was when I was a senior in college and I interned as an analyst for an investment firm in São Paulo. I worked on financial valuations, comparables, DCFs, and even did a presentation by the end of the program. And after graduating, I built on that foundation working in FP&A. In my most recent role, I worked at a tech startup where I worked closely with leadership on financial modeling, analysis, and forecasting. And during that time as well, I completed my MBA and also did a couple of online certifications, including financial modeling, valuation, and analysis, and a specialization in investment banking and private equity.
Okay, awesome. And so you have had a lot of different finance related experiences. What made you interested in banking in particular then?
Well, what interested me in banking in particular was the fact that growing up, I always would hear my dad talk about IPOs and going public, and I never really understood that. He is a corporate lawyer, so I grew up in that kind of environment. But as I pursued my career in first mechanical engineering and then in FP&A, I always thought it was really interesting how you were able to analyze a company, crunch numbers, and be able to tell a story from it, and then be able to provide your feedback to your clients. So that's what drives me to pursue investment banking.
Okay, and what about Harris Williams in particular? What interests you in the firm?
Well, multiple things, but I'm going to break it out in three particular things. First is the firm focus on middle market M&A. Middle market M&A, usually a lot of the companies that are doing transactions are very dear and close to the founders. So the quality of the work and the execution are obviously very important, but the relationship you build with the person, with the client, is really interesting to me. Number two is the level of responsibility that Harris Williams expect from you. They expect you to always be proactive, help the team, and you get to work closely with senior bankers. Obviously, as you move up, you increasingly interact with clients, and that's the level of responsibility that I'm looking forward to. And third and final thing is the level of teamwork and collaboration that I have seen from talking to people that work in Harris Williams. A cool fact that I've recently learned through listening to a podcast that one of the managing directors conducted is the fact that 70% of the revenue comes from repeat clients and around 83% of the senior bankers were promoted from within. So those numbers are really, really cool to see coming from investment banking.
Got it. And what about why are you interested in tech in particular?
That's a good question. So, I have always been genuinely interested in technology because it's such a dynamic and impactful sector that we see on our daily lives. And at my previous role, I worked inside an autonomous vehicle and tech company and saw firsthand that evaluating a technology company requires much more than understanding its products. You have to have a firm understanding of the customer adoption, the recurring revenue, how you differentiate yourself from other competitors. And I also find that the current impact of AI is fascinating because it's changing how we evaluate competitive companies and how durable a certain software company moat is.
Okay. Um, Along those lines, then, can you tell me a bit about a deal that Harris Williams has worked on?
Yeah. So while researching the firm, one transaction that I found really interesting was Harris Williams' advisory services to the sale of Softion to a company called IFS. The deal was announced in December 2025, but it was completed in March 2026. So the transaction expanded IFS into approximately $8.6 billion of warehouse management system, and which that market alone is growing about 12% yearly. And what was really interesting was the strategic rationale behind the transaction. So, to give you a little bit of background, Softion is a cloud-based warehouse management software, and IFS provides enterprise and industrial software. So the main mission, the main goal that both companies had was to solve a problem where companies, they basically operate disconnected in some way from between the enterprise and the warehouse system. So that ended up creating a gap basically between the management team and what is physically happening on the warehouse floor. So basically combining IFS industrial AI with Softion warehouse management robotic and capabilities, that new formed company is able to tap into a unified supply chain platform.
Okay, so do you have any information on the transaction value or like any of
I
those
couldn't find
statistics?
anything. I know that the market itself is growing 12% yearly, but those numbers are probably retracted or something.
Got it. Okay. Let's move on now to technicals, and let's start off with some accounting questions. So the first one I have for you is, let's say a company increases CapEx by $100. What happens to the three statements?
Well, if a company increases its CapEx by $100, and I'm gonna assume the company pays cash and there's no immediate depreciation. First, there's no impact on the income statement. Cash flow from operations does not change. Cash flow from investing goes down $100, so that ends up being a net change in cash of negative 100. And that negative 100 flows to the top of the balance sheet, where cash starts at negative 100 and PP&E is up 100. So you end up having a balanced balance sheet.
Okay, great. And let's talk a little bit about EBITDA, which is a very common metric that a lot of investors, companies focus on. But
Yep.
can you tell me why it's an improper or imperfect proxy for free cash flow? And give me like three reasons.
Yeah, that's a good question. So first off, the formula for the general free cash flow is cash from operations minus CapEx. So technically, anything that happens between EBITDA and that formula particularly could be a reason. But to give you three concrete examples, it could be how CapEx, for example, it doesn't impact EBITDA, but it does impact free cash flow. Changing net operating capital, taxes, or interest expense can be another factor.
So you're saying that can you repeat like exactly what your three reasons are? One was that CapEx
So,
isn't shown by EBITDA. What were the other second
so
and third one?
CapEx, changing net operating working capital, and interest expense will be my top three reasons.
Okay, got it. And then what about, can you give me the formula for enterprise value?
Enterprise value is equity value plus debt minus cash plus non-controlling interest plus preferred stock.
Okay. And can you explain to me what non-controlling interest is and why it's a why it's something that you add back in your enterprise value formula?
Yeah, sure, of course. So non-controlling interest represents the portion of a consolidated subsidiary that the parent company does not own. And the reason why it's added back, because the parent company financial statements include 100% of the subsidiary revenue and EBITDA, of course. So for example, let's say we're taking a look at EV to EBITDA. You have to have both nominator and denominator attributable to the same capital provider. So you have to be able to compare apples to apples. And if your denominator, in this case EBITDA, does account for non-controlling interest, your nominator, which is EV in this case, has to have that non-controlling interest.
Okay, great. And can you tell me about a tech company you've been following recently? Just briefly, kind of go through their business model.
Yeah, of course. This honestly is my favorite part of the process. I really enjoy it. So I've been following very closely a company called Airtable, and it actually just got acquired on August 4th. It was an all-cash transaction, and the buyer was actually an Italian company called Bending Spoons. And the target company is a no-code platform that offers workflow and database software. And let me see if I can remember. Airtable is valued at approximately $1.2 billion in enterprise value, and its equity value is approximately $2.25 billion. And it has a lot of cash sitting on its balance sheet. And the interesting fact is that Airtable's ARR, which stands for annual recurring revenue, is approximately 480 million, and that growth rate is approximately 20% year over year. So that means that transaction is roughly 2.6, 2.7 ARR. But what really strikes me the most about this deal was that in 2021, Airtable was valued at $11.7 billion. And now it's being valued at only $1.2 billion. So that is like a 89% decrease in value. And that is really interesting for me because the amount of value that has decreased over only 5 years is absurd.
Right. Yeah, I've seen that on the news as well. So you've kind of mentioned it a little bit about it sounds like you were thinking of multiples, but if you were going to value Airtable, let's say you're on the desk and you have a board deck next week and you have to value Airtable as a potential acquisition, and let's say you're a part of Bending Spoons and you're on the buy side, how would you value Airtable? Like what kind of methods would you use, and kind of walk me through your thought process as you think about like your different assumptions and the different analyses that you would use?
Yeah, so, well, the first thing that would come to my mind is obviously evaluated based on the three classic valuation methods, which is the comparable companies, precedent transactions, and DCF. Now, for me personally, I feel as if the intrinsic valuation, in that case, DCF, would be really, I would have to be very careful because, like I said, the numbers itself are very good, but it is currently being traded at a very lower multiple. So even if I do decide to conduct a precedent transaction analysis, that would not really even be realistic because other companies would also have their own premium included in that transaction. But that transaction could have happened years ago in a different economic society, which it wouldn't really make sense to conduct at this time. So I'm left with only being able to do comparable analysis and be able to take a look at what other companies are trading at this time, which I know that Currently, they are trading at around 4x, which is not too far from the 2.7x ARR that Airtable is being traded at.
So you mentioned that for transaction comps, you wouldn't use it because right now it's a different economic scenario as versus like 5 years ago, a few years ago. But that's true all the time with precedent transactions, right? So
Yeah.
how would you kind of explain like why you wouldn't use precedent transactions when it's always going to be the case that you're going to be comparing against different time periods?
That's a good question. Well, there are a couple of reasons why I would do precedent transactions. I would try to maximize the pool of companies that share similarities with the company that I'm trying to evaluate. So whether that be in the same industry, the same size, the same growth rates, or even same geography, those all could be good signs if they do share them. But I think you are right. You touched on a very good point. If a company was traded 10 years ago, that can be a little misleading. But generally, if they are traded 2, 3 years, that should not be as big as a problem.
Okay. And what about the DCF? Do you know at all if Airtable is like profitable or we're on the road to profitability?
Given that they probably have the same amount of cash that they do enterprise value, they should be profitable. And given that they're a pretty mature company since they have been around for a while, more than 5 years, and their enterprise value multiple was pretty high, at least back in 2021. I can only assume that they are profitable.
Okay. So if they're profitable, then why would you not be a proponent of using the DCF?
Only because with the DCF, the value that they offer, for example, they were evaluated at almost $12 billion in the past, and now they're being evaluated at 2. So the numbers are good. They have good numbers. Their ARR growth rate is 20%, and they have a lot of cash. They have $2 billion in cash. But those assumptions, they can be a little misleading because you're doing a evaluation to understand what the company will be valued in the market. So at the end of the day, you need to remember that if the people who are going to buy the company don't view it as valuable as you do, it doesn't matter how pretty or how good your numbers are. And your DCF is an intrinsic valuation that depends on your own assumptions. So even if they are okay assumptions, they're still your assumptions.
Okay. But I would argue that, so what you're saying right now seems to kind of be working a little bit backwards with Airtable was previously valued at like 11 billion. Now it's like 2 billion. The DCF is probably going to show you that the company is not worth that much or something like that, right? But maybe what happened actually is that the company was valued at 11 billion because VC investors were chasing hype, and Airtable was like a popular software company that a lot of people were using, and then it just like skyrocketed in value. But the intrinsic value of it, when someone ran an actual DCF on it, showed that the company might only be worth actually like 1.5 or 2 billion. Now, I'm not saying that's exactly what happened, but it feels like you're a little bit kind of in this mindset that because of what has happened to the company's value, that DCF would not be a good kind of valuation methodology, when that shouldn't be part of the picture, right? Like you're trying to find the intrinsic value of a company with the DCF, regardless of what's happening, so you can get to what you think the company is worth, right? So, am I like putting any words in your mouth, or
No, I think you're right. I think you're right. No, you made it a lot of sense. So when doing a DCF, you're trying to discover the value of the company from your assumptions.
So let's go a bit into some DCF conceptual questions. So for a company like Airtable, what would you think that their WACC would be? Like, give me a range.
For a company with As far as Airtable, well, given that they have a lot of cash and their equity value is around $1.3 billion, I would try to guess at around 7%, but that's only a guesstimate. I would have to have their equity, their percentage of equity and percentage of debt, so I can calculate a WACC.
Okay. Why did you mention that they had a lot of cash as you're thinking about WACC? I wanted to understand your thought process there.
Well, it's not really correlated, but and I can be completely wrong here. Please tell me if I'm wrong. If they have a lot of cash, they wouldn't be as inclined to take on debt, and as debt is less expensive than equity, I feel like that could impact WACC and making WACC higher.
Yeah, that's definitely a factor. I guess what I would say is that when you're thinking about WACC, like can you give me like the definition of what you think WACC means? Not like
Yeah,
the formula, but just like what does it mean?
WACC stands for the weighted average cost of capital. So it's the cost that you as a company have to cover to provide back to all your capital providers. And in an intrinsic evaluation, it serves as your discount rate.
Right, right. So because we're thinking about, I think like another way to put it, which and your definition also makes a lot of sense, is like the overall, in one sense, it's kind of like the overall riskiness of the company's cash flow. And then also on the other side of like, from the investor's perspective, like if anyone's investing in the company, what is the blended rate of what investors expect in terms of when they put a dollar in, what return do they expect, right? So then there's equity holders and they have what they expect, and debt holders, and they have like their own expected return rates. And I hear you on what you're saying about, okay, if the company has cash, then maybe they don't need that, right?
Mm-hmm.
But equity for the most part is more expensive than debt, right? So then that may probably actually, in following your logic a little bit, make your WACC even higher if there's more
Yeah.
equity than debt.
Mm-hmm.
But kind of like besides that, I guess like going to your answer of 7% for WACC, if you think that Airtable is like 7%, what do you think like a company like Apple's WACC would be then?
Well, Apple is considerably a more mature and stable company, so its WACC would probably be lower than 7% and around 5 or 4%.
Okay, got it. So just as a real quick like correction, so 7% is actually like very low. So it's
Okay.
already kind of like if you think of like debt instruments, they already pay something around like 4 to 4.5% or so
Okay.
for the 10-year treasury. So if you add equity onto it, it's going to be a lot higher. So just
Mhm.
for you to know, and I think this question does trip up a lot of people because it's just like a right or wrong answer
Yeah,
almost. You
yeah.
just have you just have seen it before or you haven't. It's not like a matter of how deeply, or it's not like a super like open-ended question, but
Yeah, yeah.
10% is for like a normal company.
Um,
12 to 14% is like a very like more risky company.
okay.
It could be even higher for a startup. And then a company like Apple would probably be around like 7%, a lot lower. Now, this
Okay.
changes a lot depending on the markets and interest rates and all of that, but something good for you to know. I always think though, 10% is like a good kind of like
10%.
average number for like the average company,
Okay.
and then lower for more risky ones.
Thank
So
you.
on the topic of WACC, and we've been talking a little bit about that. Let's say a company has an increase of debt. What happens to a company's WACC?
If a company increases its debt, WACC tends to lower. But you have to be careful because, for example, let's think about um, I don't know, the graph. For example, let's say that WACC is on the y-axis and debt is on the x-axis. You basically have a U-shaped formula. So if you increase leverage at a certain point, sure, your WACC is going to lower. But if you keep increasing your leverage, eventually the company is going to become a lot more riskier. So your WACC is going to, at the end up increasing. But at first, it's going to decrease.
Okay, perfect. All right. Let's stop it there. And I wanted to leave some time for feedback. And
Okay.
so I think starting off with overall, like your overall tone, your calmness, and your portrayal or kind of the way that you explain all your answers, I would say is good. You're very
Okay.
calm, and even if like internally, maybe like 'cause I know we were going through some questions where I think
No, I appreciated that. Yeah.
yeah, it was like a little bit challenging, or maybe stuff you haven't thought about before. You were actually very calm on the outside, which is not easy to do because everyone's been in that situation at one point.
And I'm sorry if I embarrassed myself, but
No,
I
no, no.
genuinely appreciate it.
No, no. I think you handled yourself really well in those moments because I know what it's like to be in your shoes, basically. And like you asked a question, you're like, oh man, like I know this is not going exactly how I want it to go. Well, I'm going to get to that, but let me go overall into like behaviorals first and feedback. And then for technicals, I just have like a few things since
Okay,
they're
okay.
just like pretty much you get them right or wrong. But for starting off with your tell me about yourself. So things I liked is that you talk about your background, about how you were in athletics. I think that always provides like a solid image into the banker's head of what type of person you are. So, you know, you're a swimmer, you're a captain, you are diligent in having to go to practice and like working out and like being part of a team and all of that. Like all of that comes into play. So I like that. And then you talk a little bit about how you were an analyst in Sao Paulo working at PNA. I felt like during those parts is where I felt like your story just ended up sounding a little bit not as like kind of like exciting or like interesting. Now,
Okay.
like you don't need to have a movie like where it's like a crazy story or anything like that. But I think where the answer kind of starts to lose the interviewer a little bit was when you talk about like, oh, I did a presentation to like my seniors or something like that.
Yeah.
I think there are some details like in there that you don't really need to include.
Okay.
And then you can make it just sharper by, you always want to think about as I'm bringing in each part of my story, what is like the key hit and what is like the most important, like interesting thing I can add to it that's like related to banking. So I would kind of think about that as you're writing your answer, kind of like working on your answer. And I would also love to see a little bit more of a tie-in if you're going to talk about like being on the swim team and all of that and how that may have influenced you in choosing your career, you know, that pivot a little bit more to like finance, especially for athletes. What I hear often, for example, is like I used to be an athlete, but then maybe I had an injury or maybe I realized it's not what I want to pursue professionally. So I was looking for something that I could channel my competitive energy into. And as I've maybe you were influenced by like your parents who ran their own business, or you had a mentor or something like that, and then you realized that finance was like a great path for you where you could really kind of channel that competitive spirit, right? Like
Okay.
I would love to see a little bit more tie in there. So that's the tell me about yourself. And for why banking, so you talked about how your dad's corporate lawyers spoke often about IPOs. You know, I think that's like great when you can always talk a little bit about your personal, like kind of family history. And then you said, you talked about your experience in FP&A and how you can analyze a company and tell a story about it. But overall, I thought your why banking answer was a little bit short and like a little too concise. You want to strike a balance where you're not necessarily gushing over like wanting to have been a banker since you were 5 years old, but you do want to have a very thorough answer that makes someone really think like, oh, this person has really done their research, has really explored the industry and really wants to go into this industry without being like a tryhard. That's the balance you will kind of want to strike. I think with the tone that you have throughout the interview, you definitely will be good at striking that balance. But what I would love to hear more about is your actual passion for the industry and how that came about.
Hmm.
So your dad was a corporate lawyer. You got exposed to IPOs. You worked on FP&A a little bit. But was there anything else you did? Like did you start building valuation models on your own for stocks you were interested in? Did you start investing in the stock market? Was there anything in like a particular project and analysis that you did in FP&A that like really, really showed you, okay, if I really want to pursue what I really think is like the next best step for my career or what I want, like it's investment banking. And it's this analysis that led me there. I would love to hear like a little bit more of that for your why
Okay.
banking. I'll pause for questions after going through behaviorals, by the way, in case you
Okay.
have any.
Yeah, I'm writing down some notes.
Oh yeah, no problem. So the next one is we went through why Harris Williams, and I actually really liked your answer. So I have one tweak I have that I would like you to make, but overall your answer was really good. The middle market M&A, you're really close to founders. That is definitely a differentiator for middle market banking.
Hmm.
I would say just as like like a small maybe like tweak or something for you to know is that it sounds a lot nicer, when it's like, oh, you work closely with founders and you work with these companies that, and like the bank like cares so much about them, or like the founder does. And I think that's true to an extent, but it's not all just like kumbaya. Like at the end of the day, it's kind of like still banking. So it's something like good for you to know. And I don't want you to go into an interview and like overplay that part, if that makes sense.
Understood.
Yeah.
Understood.
But I get what you're saying, and that part's good. Second, like level of responsibility and interaction with clients. Like I do think for a lot of like middle market banks, you do get a lot of responsibility. And so that's good. I also liked your third one where you said you spoke with people at Harris Williams, or you listened to a podcast and you spoke about like some statistics. Like I thought that was great.
Hmm.
The one thing that I would change is if you did speak with bankers at Harris Williams, I would move that to the very front of your answer.
Hmm.
So you want to, with this question of like why our bank, you want to establish your credibility up front. And the best way to do that is to talk about who you spoke with in the which bankers you have spoken with, so that everything else you say sounds very credible, right? So if you started off your answer by saying, my interest for Harris Williams really stems from a few conversations I had with like Jack and Andy and Sarah, analysts and associates in the New York group. From our conversations, what I discovered are three main aspects of Harris Williams that really attract me to the firm. First is blah, 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 right? That way the banker is like automatically, okay, what
Knows. Yes.
Leonardo is saying is actually straight from bankers themselves.
Hmm.
So it'll make for a strong answer. And then the next one was why the tech group. And this one I felt like needed a lot of work. Kind of similar to your why banking answer. It seemed a little bit like you could provide a little bit more. So first you mentioned like you've been interested in tech since it's been affecting everyone since their daily lives. And I would stray away as much as possible from those kinds of like kind of generic sentences that almost anyone can say. Because I could say that too, right? And I'm not recruiting for tech. You want to, for a lot of times for behaviorals, the main thing you kind of want to think of is how do I create a very unique personal answer? And unique and personal does not mean it has to be a crazy story. It just needs to be like very personal to you. So even something like, as you said, like, oh, I got exposed to finance from my dad, who's a corporate lawyer who worked on a lot of IPOs. Like that is personal to you, not anything like super crazy, but it's something only like, I'm sure other people with that specific situation can say it, but very few, right? Like you and only you can say that. And so when it comes to why tech, you want to start off with maybe like a key moment in your childhood or in high school, or maybe even recently, that really got you interested in tech in a way that is as unique to you as possible. So following up on that, like one thing that you did mention is that you worked on an autonomous vehicle company and you kind of got to understand the business model and all of that. And then you kind of talked about how like AI is fascinating and impacting everything. I like the part where you included the autonomous vehicle portion. The AI part, I think also these days sounds a little bit too generic. Like I think it's fine that you're interested in it,
Yeah.
But I wouldn't say that that should be the primary reason, like you say you're interested in tech, because I think a lot of tech bankers, when they hear that, they're not going to give you like bonus points because this person is interested in AI.
Hmm.
They're going to kind of just be like, oh, another person who's like interested in AI, essentially.
Yeah.
So you want to, I think this one, you're going to have to kind of go back to the drawing board a little bit. Think about, like what are the reasons that I truly want to work in tech? Like what are my experiences in life that give me a lot of credibility as I kind of work on this answer?
Hmm.
And then the last kind of like market slash behavioral question was a deal that Harris Williams worked on. And for the most part, I liked a lot of what you talked about. I asked you late at the very end, like, hey, is there any like numbers you could tell me? But
Yeah.
it seems like it wasn't public, which is okay. That's totally fine. But I would mention that up front and say that it was like a private company or something like that. The deals weren't provided, just so the banker doesn't like wonder why you're not giving those numbers up front. And then you did choose a deal that was in 2025, completed in March 2026. But in general, like a little bit more ideal if you're able to choose a deal that was in 2026, just like as a heads up, but not the end of the world. And I liked that you had you definitely like looked into the deal, like the strategic rationale, the metrics that you provided of like the market growing and like all of that was good.
Hmm.
I thought like in the middle, your answer, it kind of was going a little bit too much into the weeds a little bit when you were talking about how the two companies like worked in terms of like strategic rationale, like what does each side was missing and stuff like that. I think it could just be sharpened up by reducing the amount that you're speaking about that by like around half. So just
Okay.
like say like one or two sentences that kind of more crisply, sharply what the strategic rationale was, because there's a lot to always unpack with this answer
Yeah.
or with this question. I mean, so that's the behaviorals overall. Do you have any questions before I move on briefly to the technicals?
No, I mean I've been taking notes, but this is a little unrelated. Am I able to go back and watch the whole unedited video in case I missed something or
Yeah,
no?
yeah, for sure, for sure.
Okay, okay, okay.
Yeah. Okay, so for technicals, you got most of them right. So I'm just going to kind of skip to the ones that wanted to give you a little bit of feedback on.
Hmm.
So for let's see, honestly, it was really mainly the one where I talked to you about a company you've been following and how to value the company.
Hmm.
That and like WACC. So for the company you've been following and how to value it, I feel like you really kind of put yourself into a trap, because
Yeah.
you kind of mentioned a few things that were, in my opinion, very just not correct. And then once you have said that, then it's really hard to like reel yourself back, right? So you mentioned like, oh, present transactions, like I wouldn't use that. DCF, like I don't think it's best. I would only use comparable comps. Very, very rarely will you ever be in a situation when you can only use like trading comps for your valuation.
Okay.
Even like biotech companies that are unprofitable for 5 to 10 years, just
Let's
spending a
see.
lot on R&D. Afterwards, you build like a 15 to 20 year DCF. Everything's going to be probably wrong in your assumptions, but you still build that DCF.
Yeah.
And once the company's profitable, and for a company like Airtable, I personally don't know if it's profitable or not. But even for tech companies, like you can build a DCF for them, even if they're not like super profitable in the beginning, because you just assume profitability in the later years. And so your assumptions are probably going to be wrong. Like, every single model pretty much is always wrong,
Yeah.
but you still build one to get a sense of like, what assumptions do I need to believe to pay this much for a particular company? So
Okay.
I guess the bigger lesson though is to kind of be careful about like the comments or about what you say, because you can get stuck in a trap. And whenever a banker hears an answer that is like not on the right track, they will like pounce on you. And like I could have like actually pounced even harder on like some of the parts of like the present transactions, the DCF. But then I didn't want to. But like in a interview setting, they could potentially do that. So
Understood.
just to I think like the best way to prevent that is just kind of like building on your foundations and making kind of sure that you have like all the concepts just like fundamentally like a little bit more sound essentially. Because besides that, the other way to go around it is like, let's say you say something and after the banker kind of corrects you, you realize you were kind of in the wrong situation. Then you just want to correct yourself and try to move on with the rest of the interview. That's really like the best you can do. Similar situation kind of like with the WACC. Again, I kind of give you some feedback about this as we were talking, but
Yeah.
I feel like this actually trips up a lot of people and a lot of candidates because honestly, you'll never get this question wrong because it's kind of like easy. But most candidates have never thought about like, oh, what exact percentage of WACC should be used for like a company. So yeah, I think besides those two questions, everything else you did pretty well. Did you have any questions about the technicals?
I was gonna ask, but again, I don't want to sound like because I'm not a banker, so obviously I don't know. But like for example, I believe you, and I do think you are right, obviously. But like if a company is not making any money, for example, let's say, and you come up with a DCF that has pretty good value, you can technically do it, but wouldn't it be like,
Inaccurate and not useful.
yeah,
Yeah,
I
yeah.
mean, not that it's a waste of time by any means, but like,
No, it could be definitely. So, well, the reason that I kind of pushed you on it was I asked you at some point about like the cash, and you kind of mentioned yourself that you thought the company was profitable, right? Usually, the DCF is a lot less useful the more unprofitable a company is currently because
okay,
everything's about cash flow, right? And very, very immature companies will have negative margins that will be spending everything on like marketing and they'll be unprofitable, just trying to ramp up and achieve profitability in the future. But the more profitable a company is, the more and more that they have figured out their OpEx and how to sustain profitability. So that means like a DCF is a lot more useful. So in this
yeah,
particular case, I don't know what Airtable's numbers are, but based on even what you kind of told me, it sounded like a DCF could be useful.
understood, understood. Hopping back just a little bit. So the main idea that I want to try to think about when doing behavioral, especially now that I'm gonna try to go back to the drawing board, is think of something that's very specific to me. It doesn't need to be like something extraordinary, but something that only I can say. And bringing up stuff like I always liked something or AI that anyone can say is a big no.
Right. Also for a company like Harris Williams, I doubt they're even going to be working on AI deals because have been a lot of AI deals, but I don't know if there's that many in like the middle market range. And I feel like a lot of at least the well-known AI companies kind of get sold for like billions and they're probably going to go to like a bulge bracket bank or elite boutique. I'm not an expert in like the AI
No,
M&A
yeah, that
markets,
makes
but
sense.
that's kind of like my intuition is what is
Hmm.
telling me. So that's also why like I wouldn't necessarily just mention that for like this interview with like Harris Williams.
Okay,
Yeah. So I guess if you don't have any more questions, it seems like overall, what I would kind of rate the performance as. So, okay. So the bad news, unfortunately, is that I would not pass you to the next round. I would kind of
okay.
give you this like a 6 out of 10 or so. And the
Hmm.
reasoning for that is like, and the good news actually is that I think you have a lot of strong foundations. So
Okay,
a lot of things are headed towards the right direction. You clearly are someone who has studied the material, who has prepared for the interview. But as we've talked about, there are ways so you can really sharpen your behaviorals and really sharpen your kind of technical foundations so that you wouldn't like find yourself in like these kinds of traps in the
understood.
future. So I think even though I would not pass you if this was a first round interview, I would
Hmm.
say that with just like I would say maybe like 1 or 2 months, or if you like really really crammed a lot of preparation in just like a few weeks, you could definitely get to the point where you would be passing.
Okay,
I
okay.
also think that if you happen to get lucky and you're in an interview setting like today with a banker who for whatever reason, just asks very simple, simple technical questions, then I do think you could pass to the next day. But then at the super day would probably give you some challenges with maybe like tougher technicals or digging into your behaviorals or something like that. So that's kind of like wraps up my feedback. Did you have any questions about anything?
No, that was good. That was good. That was honest, and I appreciate it very much. I needed that.
Yeah, no problem. And I know it's not easy to like, go through these mock interviews and stuff like that. And you always get put on the spot. But overall, I think you have, as I said, a lot of really great things going for you, really strong foundations. And you also have something that can't really be taught, which is like good interview presence, very calm, collected. And you made comments in between where you said stuff like, this is kind of like the part of the process that I enjoy, stuff like that. I actually wouldn't say that, by the way. I forgot to give you this feedback in an actual interview, because that's almost like breaking the fourth wall where you're talking about a recruiting process while you're like interviewing,
I pan into the camera and I look at the camera.
Yeah, exactly. But I think wherever you can keep things lighthearted and they're appropriate, that's always like good. And I think you have a lot of that going for you, like really good, like kind of interview presence. So yeah, that pretty much wraps up everything. But yeah, thanks so much for making the time to do this.
Thank you. I appreciate your time. Thank you.
Yeah, no problem. All right, so that concludes the mock interview. Hope you guys found it helpful and were able to learn a lot. Leonardo is definitely building his foundations, and so it wasn't a perfect interview, but he was super kind enough to be willing to have all of this publicly posted, because in his own words, he said after the interview that he feels that it's helpful for people to see not just a perfect interview, but also one where someone's kind of like a work in progress. And Leonardo is actually a member of my mentorship program, the Banking Accelerator, where I focus on helping students break into banking. And if you're interested at all in recruiting for investment banking, I'll leave a link below where you can work with my team to help land your first investment banking offer. And as always, thank you so much for watching and tuning in. Hope to catch you in the next video.